The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and on behalf of the Florida League of Cities, welcome to today's webinar. I'm Teresa Colvin. Today's session is titled, The Changing Landscape of the Municipal Bond Market. Before I introduce our speakers, I would like to take a moment to mention the Florida Municipal Loan Council, which is administered and sponsored by the Florida League of Cities. The Florida Municipal Loan Council is a full-service, fixed-rate loan program for cities and other local governments of all sizes. Loan proceeds can be used for capital projects, renovations, fixed asset additions, or to refinance existing debt. The Council also provides post-issuance compliance services, including arbitrage rebate and continuing disclosure for the life of the bonds. In addition to fixed-rate bonds, the Council offers a competitive capital access program for bank loans. The Council is governed by a board of 7 directors, each of whom are elected public officials, and are appointed by the President of the Florida League of Cities. The Council works with a team of professionals, including today's speakers from Public Resources Advisory Group as its financial advisor, to deliver cost-effective financing and post-issuance compliance for its members. Since 1999, the Council has issued more than $1 billion in bonds across 58 borrowers. For more information about the Loan Council, please visit the Florida League of Cities website. We are very pleased to have with us 2 speakers for today's session. First, I would like to introduce Marianne Edmonds. Ms. Edmonds is a Senior Managing Director and Partner of Public Resources Advisory Group, or PRAG, a municipal advisory firm located in St. Petersburg, Florida. Ms. Edmonds' experience with Florida and its public finance practice is recognized by her peers and professional colleagues. In addition, Mrs. Edmonds has served as financial advisor for financing by Miami-Dade County, Broward County, Hillsborough County, the cities of Tampa and Orlando, the state of Florida, and several state agencies. Ms. Edmonds is a member of the Board of Directors of the Municipal Securities Rulemaking Board. Ms. Edmonds has a bachelor's degree from Northwestern University and a master's degree in business administration from the Wharton School at the University of Pennsylvania. Our second speaker is Mr. Paul Sober, Managing Director with PRAG. Mr. Sober has worked in public finance and investment banking since 1998 and provides quantitative and credit support on PRAG engagements in Florida. Mr. Sober received a BSc in Mechanical Engineering from Duke University. Welcome, Marianne and Paul. Before we get started, I'd like to remind participants that this session will last 50 minutes with 10 minutes for questions at the end. Please hold your questions for that time. Please use the Q&A section to submit your questions during that time, or you may submit them to your webinar speaker via their contact information at a later date. Today's webinar presentation will be posted in the League's website at FloridaLeagueofCities.com under the Events and Training tab following the session. Thank you again for joining us, and now we will hear from our speakers, Marianne Edmonds and Paul Sober.
Hello, thanks, Teresa. What I wanted to do today is talk a little bit about the changing landscape of the municipal bond market. In order to do that, we really should take a look first at the municipal bond market, that is the financial interest rates movements that are taking place. Then I'd like to look at federal legislation and regulation, talk a little bit about some state legislation, and we will close with some program notes from the Florida Municipal Loan Council. So in order to talk about the market, I want to look at some general market levels. We'll talk a little bit about fiscal and monetary policy, and then look at the economy and some municipal credit issues. So one doesn't have to study the slide too carefully to see the points I want to make. If you look over to the left, it's the dotted line. That dotted line represents the U.S. Treasury, 30-year U.S. Treasury interest rates, beginning in 2007, going up through January 1st of this year. And you can see on the left, the dotted line is above the other 3 solid lines, which is what you would expect. U.S. Treasury bond rates are higher than tax-exempt municipal rates. But then look what happens when you get to 2008 and through 2009. The Treasury rate drops below those other bars. And what happened there is that for the first time, we saw a disruption in the traditional relationship between taxable U.S. government rates and the tax-exempt yields on municipal bonds. So the next point I want to make, and then I'll pull this all together, the next point I want to make is let's look at the relationship between the AAA-rated municipal bond. That is, if you look at the left, the blue solid line that is the lowest of those lines. That's the AAA. And then look at the gold or tan-colored line. That represents an A-rated credit. So I'm talking about credit ratings here. And what we're looking at is the difference between the AAA-rated bond, which is lower than the A-rated bond. It's a very narrow difference when we look at this on January 1st of 2007. Now look at January 1st, 2009. The gap has gotten considerably larger. So what's happened? When you look at January 1st, 2009, you'll see the U.S. Treasury rates have plummeted to below all the other rates. Investors are seeking quality in their investments because they're afraid of the disruption in the financial markets. The spread between the AAA-rated blue line and the tan color A-rated line is the widest there, showing that credit matters. That is, the rating on your bonds is going to determine the rate you pay when you borrow money. Finally, if we go over to the far right, you'll see that beginning at about January 2013, the lines are all trending upward. Not exactly, a few peaks and valleys in between, but a general trend upward. Rates are moving up. That's attributable to the Federal Reserve starting to taper their purchase of federal securities. And I'll talk about that in just a minute. Ever since the financial crisis began, the Federal Reserve has been depressing interest rates by stepping into the market and purchasing securities. So if they purchase securities, then there is more demand for securities and interest rates drop. Now the opposite is happening. The Treasury has announced that they are tapering their purchases of securities. That means there are less buyers for bonds. That means bond prices will drop and interest rates will increase. That will mean that bond issuers, whether they're corporate borrowers or municipal borrowers, will have higher interest costs associated with their debt. So we've looked a little bit at interest rate trends, what's happened over the last 6 years. We've looked at credit spreads and how those matter. We've talked about changes in the trend of the market. And now I'd like to take a look for a minute at some of the issues that affect credit ratings, which impact the price issuers pay when they borrow money. The first thing I want to talk about for a minute is pension liabilities and OPEB liabilities. Now, there's not much that I can tell this group about these items. You all have been living with pension and OPEB issues for the last few years. But I wanted to talk specifically about what's happening when you look at GASB 68 and compare that to the way the rating agencies are going to analyze your pension, your unfunded accrued pension liability. As you all know, GASB 68 has looked at three things, really. It's looked at how to project future benefit payments. It's looked at the present value of those future payments. And then it's talking about, GASB talks about how you attribute or allocate the present value of the payments to the periods in which they are earned. So the thing I want to focus on here is determining the present value of the future payments that are to be made. GASB allows issuers, when reporting in their financial statements, to use their long-term expected rate of return. So if a pension board decides that a 7% rate of return is what's expected, then that's the discount rate that will be used to present value that future stream of liabilities. Moody's has set some new criteria for how they will analyze unfunded pension liabilities. So they will be using these criteria when they do their credit ratings and setting the credit ratings for your issues. What Moody's has said is we're looking at credit, and so when we discount those future benefit streams, we are going to discount at a market rate. So while GASB will allow you to discount these revenue streams at your expected investment rates, Moody's in particular is going to require discounting at a market rate determined at the time the valuation is done. The interest rate index that they're currently using is Citibank's Pension Liability Index. Why does this matter? If under GASB reporting you're using a higher discount rate than the rating agencies are going to use, the reporting in your CAFR is going to show a lower unfunded pension liability than Moody's is going to show in their report. So what will happen is when a rating agency report comes out, there will be numbers. Those numbers will differ from what's in your CAFR. And either elected officials, the press, the public will pick up on these differences and will call them to your attention and ask questions. So it's important just to know that that's going to happen. Another thing I wanted to talk about a little bit was the headliners in the municipal market. 2 days ago, Puerto Rico was downgraded to double B status by Standard & Poor's. That's below investment grade. Now, why do we care what happens to Puerto Rico? Puerto Rico is a $70 billion municipal issuer. They're the third largest issuer in the municipal market. Puerto Rico bonds are held in the portfolios of 70% of the municipal bond mutual funds. What does that all mean? It means that there are a lot of investors who have lost a lot of value. There are banks that have lost value. So investors, financial institutions, are going to be much more careful and look much more carefully at their investments, given that they're taking these losses. So now then we turn to Detroit, Michigan. Detroit recently filed for bankruptcy. They're a smaller factor in their municipal market. They're only $18 billion as compared to Puerto Rico's $70 billion. But some significant questions have been raised by the Detroit bankruptcy. Most notably, there is a concern that bondholder promises, or at least what bondholders thought were the promises, are not going to be kept. Let me explain that. The bankruptcy judge in Detroit is going to have to decide how to allocate funds to the different creditors. The creditors include the beneficiaries of the pension funds as well as the holders of Detroit's municipal debt. Detroit's bondholders, their general obligation bondholders, thought in this market that they were being offered a top-ranked security from the city of Detroit. That is, they had first lien on available revenues from the city's general fund. That has been called into question during this bankruptcy proceeding. There is no decision yet. These proceedings are going to be going on for a very long time. There are a lot of high-priced lawyers sitting in hotel rooms arguing for the banks, the bond insurers, the various bondholder interests, and the pension beneficiaries also have their representatives. This particular issue will have ripple effects in the municipal market, regardless of how it is decided. So why do I bring these things up? Well, I wanted to indicate that there are factors that impact credit ratings, and there are factors that impact investor demand. The lower your credit rating, obviously, the higher the cost of your debt, the less investor demand or investor interest, or put it in the reverse manner, the more skittish investors are about the market in particular and your credit specifically, the more skittish they are, the less demand there is, the higher your interest costs. So with that overview of the municipal market, I wanted to take a few minutes and talk about developments at the federal level. And most specifically, I wanted to talk about the Dodd-Frank Act. And then we'll look at how the SEC reacted to that by writing and finalizing their definition of a municipal advisor. And then after that, we'll look at how the MSRB, the Municipal Securities Rulemaking Board, is reacting to the SEC's definition and writing rules to enforce that definition. So let me take a minute and explain about the Municipal Securities Rulemaking Board, because what Dodd-Frank did was change the duties of that board. The Municipal Securities Rulemaking Board is a self-regulatory organization whose job was, before Dodd-Frank, to regulate municipal broker-dealers, that is, broker-dealers who sell municipal securities, and to protect investors. So again, the MSRB's charge was to regulate broker-dealers and protect investors. The Dodd-Frank Wall Street Reform Act added 2 additional duties to the MSRB's charge. They, for the first time, required the regulation of municipal advisors and also required the MSRB to take action to protect issuers. So once the Dodd-Frank Act was passed, the SEC, Securities and Exchange Commission, had to define what was or who was a municipal advisor, so that the MSRB could then regulate those advisors. The SEC took 3 years to write this definition, and in September of 2013, they released a 777-page document that describes in great detail who is a municipal advisor and what standards they will be held to. Once the SEC rule was released, then the MSRB could start to take a look at how to write rules. But let's take a minute and talk about what the SEC final rule on municipal advisors says and how that's impacting the market. The SEC defined municipal advisors as those who give advice with regard to the issuance of municipal securities, with regard to the investment of bond proceeds or escrows, and those who give advice with regard to derivatives. So a municipal advisor scope is fairly broad. Then they came in and they talked about what is advice. When are you giving advice on an issuance? And when are you simply providing information? The SEC rule made it clear that giving advice was a fairly prescribed, had a fairly prescribed definition. And they also made it clear that those who gave advice had both a duty of care to all their clients and a fiduciary duty or a duty of loyalty to their government clients. A duty of care means is disclosure of conflicts, written documentation of relationships, make sure you make suitable recommendations. The real crux of this is duty of loyalty or fiduciary duty. That duty from the municipal advisor to the government client requires that the municipal advisor put the best interest of the client, the interest of the client ahead of their own, and that the municipal advisor exercise utmost good faith. Tell me when we're live. You should be okay. Okay, I think we're back. So I was asking, why do people, what's the big deal about fiduciary duty? And why is there a fuss about this? So the fact is that there are many participants in this market who do not want to be classified as municipal advisors. And that's because they fulfill other roles. So let's talk for a little bit about what's happened with the broker-dealer community and the municipal advisor definition. It is standard practice in the municipal business for broker-dealers, investment bankers, to call on their clients or to call on prospective clients and to talk to them about ideas. What the SEC has done in their rule is prescribe very clearly what you can and cannot talk about, and prescribe very clearly the situations under which you can go beyond that very limited information giving. And the boundaries, if you will, of when an investment banker or a broker-dealer can walk into a municipal client and talk about, hey, I have a great idea for you to save some money on your water and sewer bonds. Or have you considered doing this particular thing with regard to financing that new capital project you want to build? For an investment banker to do that now, under the SEC rule, they're going to have to meet one of the exceptions to the municipal advisor definition. They either are going to have a contract to serve as a bond underwriter to that client, or they have to be responding to a specific RFP or RFQ from that client, or three, that client has to have retained an independent municipal advisor so that the client, the government, is going to be getting advice from their advisor and therefore won't be tempted to consider their investment banker's advice as being in their best interest. So this is an area that's created quite a lot of discussion in the marketplace, probably will cause some changes in how business is done. That is, what the relationships between broker-dealers, investment bankers, municipal advisors, and their clients will be. And anytime there's change, of course, there's anxiety, and I think we're seeing a lot of that in the municipal market right now. So I talked about Dodd-Frank, and then I talked about the SEC writing this long rule that defined municipal advisor, and now the Municipal Securities Rulemaking Board has the role of implementing Dodd-Frank and the SEC definition. So the MSRB is taking on these two new roles: protect investors, protect issuers, is what they did before. Now they're going to take on, they have to protect issuers and protect investors, and they have to regulate municipal advisors. So the MSRB has issued a proposed rule. This is a rule that's out for comment. It is not set in stone. I urge any of you who have any concerns about this to, you can email me at the end of the presentation. I'll send you a copy of the proposal, and if you want to write comments to the MSRB, you can submit your comments. But what the MSRB rule G32 will do is describe the fiduciary duty and the duty of care that municipal advisors have to their clients. So we talked on the last slide about people not wanting to be accidentally classified as a municipal advisor. But if you are classified as a municipal advisor, you are required to carry out these duties: a duty of loyalty to your client, a duty of care to your client, principal transactions. Now, that's caused some conflict in the market. The proposed rule says that if a party is serving as a municipal advisor to a client for a transaction, they cannot also act as principal for any transactions associated with the issuance of those securities. This is not yet a rule. It's a proposed rule. It's out for comment, and there's a lot of controversy about it. There's a lot of confusion. If a bank is acting as a municipal advisor, does that mean that they can't also provide investment securities or escrow securities? If you have thoughts on this issue, I urge you to write a comment to the MSRB. I can assure you that many of the banks and broker-dealers are already commenting on this. Another thing that the proposed rule G42 does is it's sort of interesting to me. It requires me as a municipal advisor to thoroughly review your official statement. Now, I've been trying to figure out what I've been doing the last 22 years, but I know I've been thoroughly reviewing official statements. From now on, I'm going to have to document that I've done that, keep notes, and include in my files a statement that I've reviewed your official statement. So the Rule G42 proposal is out. The MSRB is taking comments. It's an attempt to put into regulatory form the fiduciary duty that a municipal advisor has to their government clients, and it should be released in final form sometime before July 1st this year, when the SEC definition becomes law. I'm sure we'll have more conversation about some of that federal regulation later on. I thought I'd take a little bit of time to look at some developments at the state level. Lots going on at the state, but one of the things that was most interesting coming out of the last session was the public-private partnership legislation. That legislation, which was known during the session as House Bill 85, is now Section 287-05712 of Florida statutes. There's been a lot of controversy about this legislation, and probably on one hand, there are people who say what this legislation is going to do is develop a set of best practices for local government to enter into P3s. The other side of that discussion would say that this legislation is the state's attempt to meddle in local government's affairs. I'm not going to take a position on that one. But what I am going to do is just talk for a few minutes about what the legislation clearly does. It clearly is the start of an attempt to develop a procurement process for public-private partnerships for local governments. Now, in order to do that, the legislation required the governor to appoint a task force, the Partnership for Public Facilities and Infrastructure Act Guidelines task force. And that task force is meeting on a regular basis. I believe the report is due in July, and they have been tasked with answering 7 or 8 questions about implementing and expanding the P3 legislation. What the legislation does in its current form is it sets out some procurement procedures. And one of the things it does is it allows local governments who receive unsolicited proposals to charge a reasonable application fee for review of those proposals. And as all of you know, having received some form of interest from some private vendor about doing business with you, it takes a lot of time to review those proposals. And so the payment of a fee is clearly a plus for local government. Determining the amount of that fee is going to be another question that's going to be difficult for many of us to do. Another thing that the procurement procedures set forth is a process for notifying the marketplace in general that you have received a proposal for a public-private partnership and that you will entertain other proposals on the same concept. Now, the task force is looking at the timing that will be required for that process, but nonetheless, the process is, the outline for that process is in place. The legislation also sets forth some standards for approval of public-private partnership projects. And the standards here are not really surprising. They have to be in the public's best interest. You have to look at ownership issues. Entering into a private partnership cannot cause any additional costs or service disruptions. And there has to be, and this is critical, I think, in any private-public venture, there has to be the ability to add capacity. It can't just be a standalone project with no ability to add capacity. And with that, I'm going to turn this program over to my colleague, Paul Sober, who's going to talk a little bit about the Florida Municipal Loan Council program.
Hi, good afternoon. The Pooled Loan Program is a program that's sponsored and administered by the Florida League of Cities. It was originally developed in order to allow small and medium-sized cities access to the capital markets, and was started back in the late 90s, where they would go through and issue bonds on behalf of a number of borrowers at one time and sell these pooled deals. Those occurred at least annually through 2007, when the market disruption made the process by which the bonds were issued no longer feasible. The bonds have been supported by AAA bond insurance and a reserve surety, but the demise of the bond insurers as well as the sureties downgrade made that no longer practical. So we have been working with the League trying to figure out new ways to get back into that fixed-rate bond market. The advantage, of course, with the bond market over the bank market is that you have the ability to sell 30-year debt, you have the ability to structure it however you want, and just generally more flexibility. Recently, a new bond insurer has come into the marketplace, which we think provides an opportunity for the League to maybe start doing these pooled loans again. That is Build America Mutual. They are a mutual insurance company. They focus solely on the issuance or the insurance of municipal bonds. They were launched in 2012 and have been seeking to become licensed everywhere. They now have a Florida license as of September of 2013. They have an affiliation with the National League of Cities, and we feel that actually the folks at the Florida League of Cities had some input in the actual creation of the original insurance company. So they're very proud of that. The Build America Mutual, as I said, provides insurance only for essential public purpose bonds. They're looking for issuers that are in the investment grade quality range, which is AAA, AA, single A, and triple B, and will go as low as $1 million for a commitment. So the size of the borrowing which they would look at. They themselves are rated AA by Standard & Poor's, which is really sort of one of the critical elements of using them. By having their insurance, that means that any bonds that you sell with that insurance carry that AA rating, which goes a long way towards making investors feel confident in the credit itself. In their 2 years of existence, they've insured $5.3 billion of par, which I think is certainly a large enough number to show that they know what they're doing, but certainly in our very large market, still a small amount. So there's a lot of capacity left. We are looking to put together a bond issue to bring to market, hopefully by the end of the second quarter this year. Certainly, there are a lot of candidates who had sold bonds earlier with the pooled loan program, and so there are bonds still outstanding from, I think 2000 is probably the oldest one, but anything from 2000 to 2005 would probably make sense to refund, or at least look at refunding now. There are significant savings to be gotten from those, and so our process over the next few weeks will be, we are running numbers. We're going to come to individual borrowers who have refunding opportunities to talk to them about it. Certainly, if you have either other refundings that you would like to look at, if you have new money borrowings that are sort of on the horizon, those are all things that would make good candidates for including in this program. We have, over the past few years, been focusing on the bank loan market because that's what we had accessible to us, and have had a lot of success with that, but there the limitation on term is only 10 to 12 years, which doesn't necessarily match municipal infrastructure needs, where oftentimes you'd like to go 20 or 30 years. So hopefully that gives you a little bit of an overview of where we are. Certainly happy to talk more about it on a case-by-case basis.
So this is Marianne again, and what I'd like to do is sort of, I told you what I was going to tell you, we've talked about it, and now I just want to sort of pull together these thoughts, tell you how I'm thinking about the market and what I think is critical. First of all, it's clear interest rates are trending upward. There may be dips and valleys, there may be changes in credit spreads, that is the differential between rates of different rated credits. But generally speaking, unless there's some kind of shock to the system that we're not expecting, with the Federal Reserve reducing its purchase of securities, interest rates are going to trend upward. The second thing is that credit matters. Credit matters because credit ratings have a large impact on interest rate and investor demand and interest rate. So the better the rating agencies view your credit, the lower your interest rate will be when you go to market. And finally, there are things that are changing the market that are inevitable, and that is the regulation of the municipal market. The SEC definition of municipal advisor is here, it's here to stay. The MSRB is implementing that definition by writing rules that will regulate the actions of municipal advisors, and that will change the way business is done in our market. We are happy to answer any questions. We've covered a lot of material here, and I hope this has been helpful to you today.
Thank you, Marianne. Before we take your questions again, we'd like to encourage our participants to visit the Florida League of Cities website to hear a taped version of today's webinar and receive information on past and future webinar offerings. And we've got a few questions coming through. First one is, Marion, what do you see as post-issuance compliance issues or problems among cities across the U.S.? And what can cities and local governments do to help solve those problems or concerns?
Well, some of this is outside my purview as a municipal advisor and falls into the lawyer's role, but that isn't going to stop me from at least doing some outlining of the situation. The IRS has made it very clear that they want to see post-issuance compliance by issuers. And so many of the larger issuers, many of you on the phone, have already worked with your lawyers to develop post-issuance compliance guidelines. And if you have that outstanding and you haven't tackled that, it probably is a good idea to get with your counsel or even contact your advisor, your bankers, and ask them for some checklists and start this process. The IRS is going back and auditing transactions, and none of us want to be in the position of having an IRS audit where we can't provide the information that the IRS is asking for. It's expensive and it's not pleasant. As to disclosure, the market is clearly moving to require more disclosure. The SEC released the report on the municipal bond market in July of 2012. And in that report, they were very clear on their intent to require more disclosure about municipal securities offerings. The idea is to increase the amount of information available to investors so that investors can make informed decisions. And finally, one last thing I'd say, and I would demonstrate if I felt I could touch the computer without blowing up the presentation. The MSRB has a website, emma.msrb.com. And that website is now the repository for disclosure and continuing disclosure about municipal securities issuances. So you can go to emma.msrb.org and enter any issuer's name and pull up the listing of the outstanding municipal securities. You can look at the official statements that have been issued in connection with those securities, and you can look at the continuing disclosure that's been filed in connection with those securities. That website is actually being, I think a revamp is being released tomorrow, and that website is continuing to become more robust in terms of the amount of information it's providing. I would add one last thing. There's not currently a requirement to disclose bank loan information to the market. So if you have bonds outstanding and then you do a bank loan, borrowing money maybe on the same lien as your bonds, there's no requirement right now to provide disclosure about that bank loan. If that doesn't change from a regulatory perspective, I think it is going to change from a market expectation perspective. There is a lot of pressure on issuers to provide more information than ever before.
Okay. All right. Well, thank you very much. This concludes today's webinar. I'd like to thank Marion Edmonds and Paul Sober with Public Resources Advisory Group again for an informative session. I encourage our participants to visit the Florida League of Cities website to hear a tape version of all of the League's webinars. Thank you and have a good day.